Hi everybody, this is AJ speaking. This video is a financial deep dive into BYD, the largest Chinese automaker, the global number one in electric vehicle sales by volume, the number two largest battery maker globally, and over the last few years, the by far fastest growing Chinese automaker. Upon announcing earnings, the stock dropped over 6%. And before we dive in, let's take a look at the headlines. So Reuters writes BYD's quarterly profit falls for first time in 3.5 years as price was spiked. TipRanks writes BYD reports strong interim results, reinforces leadership in new energy vehicles. Automotive News writes BYD profit slides as discounts pressure margins, aggressive overseas push drives sales. Then Automotive World writes BYD profit drops 30%, but 5.5 million sales remain doable. Talk about total vehicle sales. Gasco, it's an affiliate of Toyota, writes BYD logs 23.3 year-over-year jump in H1 2025 revenue. And CNEV Post writes BYD sees net income drop 30% in Q2 as competition intensifies. So overall, I think you see kind of a mixed picture in the headlines. A number of these headlines point out the drop in year-over-year performance. Others see, quote, strong interim results. And yet others focus on the year-over-year H1 revenue growth. If you watch this video to all the way to the end, you really know what's going on. So now let's dive in. But as always, as all my research is about investing, we need to talk about the share price. BYD's share price is up 46% over the last 12 months and is up 21% year to date. So overall, quite strong performance. And the share price I'm using is the BYD price as listed on Shenzhen Stock Exchange, because that share price is in Chinese yuan and BYD reports in Chinese yuan. Please also note all the share price etc. that I will be showing you are split adjusted, since just last month BYD did a stock split. The latest closing price as of this presentation is for August 29. Stock traded at closed at CNY 114.06, and this implies that the company trades at share price implied market value of $144 billion, and that makes BYD the number 3 or number 4 most valuable company that makes vehicles. That ranking depends on how you count. So what happened in the second quarter of this year? On this first slide, you can see total revenue development. BYD reported just under $28 billion in quarterly revenue. That revenue is up 14% year over year, and the first half is up 23%. At first glance, you might be thinking, oh, this looks quite good. 14% year-over-year growth is not bad, but that would miss already one piece, and that is BYD's history of very rapid revenue growth for at least the last 4 quarters. Over the prior 4 quarters, BYD grew either over double or almost double at the rate. So first key observation, there's a material slowdown in year-over-year revenue growth, but this happened before. So in the first quarter of 2024, there was also a slowdown in revenue growth, where the company only reported a 4% year-over-year growth. But again, this came after a period of quite dramatic revenue growth, as you can see on these numbers. But let's move on. Before we get into the weeds, let's get everyone up to speed. So what you see in front of you is BYD's segment disclosure. So how BYD decided to split its business. BYD, despite being a large industrial conglomerate, decided to only disclose 2 segments. And in fact, a few years ago, when BYD was a substantially smaller company, BYD reported 3 segments. So currently, BYD reports the segment automobiles and related products and other products. And the second segment is mobile handset, components, assembly, and other products. Before 2022, BYD also had a segment called rechargeable batteries and photovoltaic products, but then decided to merge it with the auto segment. I think this is rather unfortunate because it significantly limits our ability to work out the performance of BYD's auto business. But let's see what BYD actually does. I mean, most of you will know that BYD is a large automaker, and a lot of you will probably also know that BYD is a very large battery cell maker and sells to all kinds of other car companies. For example, Tesla is also a customer of BYD, and BYD also is active in the area of battery storage and is a quite large player in that area as well. In terms of automobiles, BYD is very large in fully electric vehicles, but is also one of the largest manufacturer of hybrid electric vehicles. And then in the other segment, in the mobile handset segment, BYD manufactures and sells handset components that are used for all kinds of high-end Android phones, PCs, tablets, and other consumer electronics. I will not go through all the details on this slide. This would take too long. So if you want to know more details, please feel free to pause the video and read through the slide. So now let's look at how BYD's segment disclosure splits out into numbers, and the two product segments and two geographic segments. This is China and everything outside of China. We can split into these buckets because that's disclosed by BYD, but there's nothing more we can do. There's no additional disclosure where we could split this further. So what we can learn from this split is the following. Of the 52 billion in revenue, total revenue reported in the first half of this year, 59% related to the auto and batteries business in China. So this right off the bat shows us that BYD is highly China concentrated, but that's probably not a surprise to most of you. The second largest segment is the autos and batteries business outside of China, 22% of revenue. But then there's this other segment, is mobile handset segment, and the China piece of that segment contributed 14% to total revenue. So this is a meaningful needle mover, but the mobile handset business in China is not. It's only 4% of total revenue. So the two key takeaways so far are, number one, there is significant China concentration in revenue. And number two, there is significant auto and batteries concentration in BYD. And that's why if you study BYD, you should focus on these areas because these are by far the largest needle movers. Before we move on, let's look at the growth profile of these segments. So the auto batteries business in China was up 14% in the first half. The non-China auto battery business was up 130%. So this reflects BYD's international expansion push. But the mobile handset segment in China was down almost 14%. And also the mobile handset business outside of China was also down, but only by 3%. And that meant that overall auto battery was up 32.5%, but the mobile handset segment overall was down 5.5%. And that combined then led to a total revenue growth of 23%. That means the headline growth rate, at least for the first half, is clouding somewhat the strength in the auto battery segment. And then lastly, if we just look at revenue in terms of geographies, China and non-China, China significantly slowed, was only up 12%, and the non-China business was up 50%. So the key takeaway is that in terms of business segments, the auto batteries business performs well, while the mobile handset business is shrinking. And number two, the China business significantly slowed, but the non-China business goes through a significant growth phase. You might be wondering why I'm not showing you this analysis on a quarterly basis. The problem is this data is not available on a quarterly basis, only on a half-yearly basis. Next, let's look at vehicle sales. This shows you latest data on a monthly basis. And please note the financials for the first half of 2025 relate only to sales up to and including June. So this latest that also shows you July is not reflected in the financials. And there are a few interesting observations for the next quarter, and because we can see that July grew only 1% year over year, is down months over months 10%. And when you look at the year over year growth rates, you can see BYD hasn't grown so slowly, basically in multiple years, if you exclude one-time effects and effects caused by Lunar New Year. So we can see already, okay, there's some clearly slowing in the auto business, but as we just looked at, the auto battery segment did perform quite well in the first half of this year. So what's going on? For that, let's look at the trailing 3 months sales rate. We see a similar picture. Growth has significantly slowed, and in July, growth has slowed to 9% year over year, and the trailing 3 months was even down 3% in July. But the prior months, June, the months that relates to the financials, slowed to 0% month-over-month growth, but was still up 16% year over year. And I'd like to point out that the Chinese government is significantly supporting the Chinese auto market since April of last year, where a significant slowing in the market caused, let's call it panic, for lack of a better word, the government to issue significant subsidies. And after initial subsidies did not create enough of an effect, the government doubled then those subsidies in mid-August of last year. And next we look at sales on a 12 months basis. And here the months over months change in the trailing 12 month sales rate decreased to 0%. In other words, BYD's vehicle growth has hit a wall. And this comes after a multi-year consistent growth trend, excluding certain one-off effects which I described on the slide, but we won't go into, it would take too long. And please remember the headline we looked at the beginning of this video, where one outlet talked about 5.5 million units. This is this number you're looking at. So they basically were talking about BYD achieving 5.5 million units trailing 12 month sales by the end of this year. Looking at this trend, I don't think that's in the cards, but let's see. Next, we look at installed battery capacity. So that includes all the batteries that BYD installed, whether this was into vehicles, fully electric or hybrid vehicles, or deployed as battery storage. And as I noted earlier, BYD is a large battery supplier, the number 2 behind CATL, and provides batteries to, for example, Tesla, Xiaomi, NIO, Toyota, but also energy storage operators like Grand Energy, and also to sovereigns like Saudi Arabia. For example, last year in 2024, BYD deployed 202 gigawatt hours, so huge dimensions. But again, this includes also all the cars. And so the numbers you're looking at, first of all, are shown in gigawatt hours, and in July, this is most recent data available, deployments or installed capacity, I should call it, were up 35%. But it's still very strong growth, but it also signals a second consecutive month-over-month declines. And July was down 17%, June was down 5% month-over-month. When we now move to the trailing 3 months trend, we can see a 5% month-on-month decrease, but gigawatt hours installed is still up 66% year-over-year. And then when we look at a trailing 12 months metric, we can see there's still meaningful growth. The trailing 12 months is up 2% month-over-month in July. So the slowing in the auto and battery segment must be in the auto business and not so much in the batteries business. And I think this chart shows this quite clearly. So this chart shows the growth rates for both vehicle sales and installed battery capacity. Obviously, since installed battery capacity also is driven by BYD's vehicle sales, because every vehicle BYD makes has a battery. These curves are somehow, or I should say, linked, but we can still see a significant outperformance of the battery business over the vehicle business. You can see that the vehicle growth has essentially slowed to zero growth, while the batteries business is still overall growing quite significantly. So that's why we need to look at vehicle sales a bit more closely, and for that we use BYD's breakdown into battery electric vehicles and plug-in hybrid electric vehicles. And we first start with battery electric vehicles, or BEVs. BEV sales showed quite strong year-over-year growth rates. In July, sales were up 37%, in June 43%, in May 40%, in April 46%. And again, for the financials, the numbers that matter for the second quarter are April, May, and June, and they all looked good. However, July, but as I said, it doesn't affect the presented financials here. We can see a quite substantial sequential, so months on months in this case, drop of 14%. But I'd like to point out that last year in July we saw the exact same drop in July. There was a drop of 10%. But again, and at that point in time, remember, in April, end of April in 2024, the government launched significant subsidies, and then in the middle of August doubled them. And then we had this significant re-acceleration into the typically strong last quarter of the year. So the question this time around is, assuming the government is not ballooning even more the subsidies, will we see a significant increase in the next few months or not in electric vehicles? But I will report back on this point when we get new numbers. So let's move on. So this shows you then the battery electric vehicle sales trend for the trailing 3 months. Here, same story. We see strong year-over-year growth rates, but July is kind of worrying. On a trailing 12 months basis, BYD's sales at all-time highs. Over the last 12 months, BYD sold 2.1 million fully electric vehicles. This places BYD in terms of volume, not in revenue, but in volume, significantly ahead of everyone else. Currently, Tesla is number 2, and Geely number 3, and 4th, Volkswagen Group, and 5th, BMW. So what we learned so far is in the vehicle sales that looked weakening, battery electric vehicle sales appear to be doing fine. So what's the matter? So the problem is what you see on this slide. This is plug-in hybrid electric vehicle sales, and they are, you be the judge, but this looks like they're dropping off a cliff. And they've been decreasing for 4 consecutive months year over year. July was down 23% year over year. June down 12%, May down 6%, and April was just a little bit negative, which is quite a substantial trend reversal, especially if you look at the super strong December, November, October months. This just shows you the, let's call it volatility of the Chinese auto market, where a boom and bust can be very close together. When we look at this in terms of trailing 3-month sales, we see how significantly trend is going down. BYD, as of end of July, over the last 3 months, sold only 506,000 plug-in hybrid electric vehicles. And the last time BYD's sales rate was so low, you have to go back to April or arguably January 2024, because April 2024 was still affected by Lunar New Year. But the key comp is the trailing 3 months of last year, and there BYD sold 590,000 vehicles. So there's a substantial decrease. And when we look at that metric in terms of trailing 12 months, we see the exact same picture. Plug-in hybrid electric vehicles peaked in March of this year and then kept decreasing consecutively in each of the following months. And I think the overall situation becomes even clearer once we plot battery electric vehicle sales growth and compared with plug-in hybrid electric vehicle sales growth. You can see that here in this teal color, BEV sales are still growing nicely, while PHEV sales are declining. So we now identified the issue in BYD's auto and battery segment, since we saw that installed capacity of batteries is growing quite strongly, or still quite strongly, but plug-in hybrid sales are weakening. We can see that the slowdown is clearly driven by that part of the business. But now let's move into financials. First, we look at gross margin. So gross margin tells you how much money is left after you paid for providing the product or service. And in BYD's case, in the second quarter, that number dropped to 16.3%. And that marks the lowest gross margin in several years, and also implies a record year-on-year and sequential decrease of 242 basis points and 280 basis points respectively. And as a rough rule of thumb, automaker needs at least 15% gross margin to remain self-funding. But this is like absolute limit. But again, it's just a rough rule of thumb, and BYD is quickly approaching that level. And as we will see later, in BYD's case, that is not even nearly enough. So we identified 2 issues thus far. Number one, the plug-in hybrid vehicle sales shrinking, and gross margin is the weakest in years. But there's a lot more, so let's move on. That weakening gross margin, despite revenue up, caused gross profit to actually decrease for the first time in several years on a year-over-year basis. Gross profit came in at 4.6 billion for the second quarter, and that then had a quite substantial impact on operating profit. So operating profit is what's left when you take gross profit and you deduct operating expenses. Operating expenses includes your R&D expenses, selling, administrative expenses, and some other things. And that caused operating profit to decrease by 69% year over year to just $400 million. And it's also a multi-year low, especially if you consider that the chart you're looking at also still includes some periods affected by COVID. And given right now we are not in a pandemic type situation in the global auto market, and we would be in something that people probably would consider like a normal market environment, there's no recession, things appear to be fine, that is exceptionally poor performance. Because remember, this company is valued at $144 billion. The net result of that was there was a revenue increase, as you saw in the beginning, and the drop in operating profit caused the operating margin, which is operating profit divided by total revenue, to drop to a long-term low of just 1.43%. So that's not only a record low, but also a record drop year over year, And that brings the the operating margin for the first half to just 2.3% and is down 215 basis points. A basis point is 0.01 percent points. So from the delta between gross profit, which if you remember, or let's look at it again, was 4.6 billion, and operating profit coming in only at 0.4 billion, you can see that operating expenses took out 4.2 billion. That means BYD has a huge operating leverage. I mean, no surprise, the company is selling very large volumes of vehicles, batteries, etc. It's a huge conglomerate, but it also shows you how important gross margins to an automaker. A few percentage points fluctuation can wipe out most profits. And BYD's second quarter is a perfect example of that. Next, we come to an area that partially saved BYD's quarter, and a topic BYD is not happy me talking about, and that is non-operating items. So here on the right-hand side, you can see what non-operating items include. It include financing expenses, other income expenses, investment income, fair value gains or losses, impairments, and other items. And that item, especially when BYD goes through a hard time, becomes extremely important. And you can see that BYD generated a positive income from non-operating items of 0.7 billion or 670 million in the second quarter, and that is actually significantly more than the operating income. In other words, from non-operating stuff, BYD generated more income than from the operating business. So forget all the car selling, all the battery selling, and all the other business, mobile, etc. From just financing, other, etc. If you add everything up, BYD made more money from that than from its huge business operations. So what is driving non-operating income? So now we decompose it into the elements, and what should immediately jump out at you is these red buckets. They clearly dominate non-operating items. So what are they? And you can see it here in the legend. It's other income. And other income is where BYD books additional subsidies BYD receives from the Chinese government. Just like in the US, automakers get subsidies for making energy efficient vehicles. But this is one subsidy layer. There are others, and there is one where an automaker, or can be another type of company as well, they get direct payments from the government. And they're not linked to achieving emission targets, etc. BYD discloses these subsidies as subsidies, quote, related to daily activities. And they are reported in other income. Here's one little problem. BYD does not split out these subsidies on a quarterly basis or half-yearly basis. They only report them on an annual basis. For that reason, we do not know for the first half of 2025 or for the second quarter of 2025 how much of other income comes from government subsidies. But what we can do is we can look at the last couple of years on a full year basis and see when it was disclosed how much of other income was government subsidies. And this is what this chart shows you. This shows you the full year amounts just for other income within non-operating income. And here again, the red bars, here you see the government subsidies. So for example, last year, financial year or full year 2024, BYD got this type of subsidy, 1.44 or $1.448 billion, and that represented 74% of other income. And in the prior year, BYD got $643 million, so in the financial year 2023, and that in that year, that represented 88% of other income. And when you look at other years, in some cases it was 100%, in some cases over 100%, and that was the case when other elements of other income were losses or expenses. So the bottom line is we can clearly see, at least over most years, most of other income is government subsidy. So then when we isolate other income within non-operating items, we see these are the amounts. And we just saw that in most years, most of that income is subsidy. So we can simplify and say, okay, the numbers we are looking at right now are probably mostly government subsidies. So if this reasoning applies here, then BYD got over 400 million probably in government subsidies in the second quarter. And that would mean that these subsidies more than doubled BYD's operating profit, because operating profit was only 400 million as we looked at earlier. And this is why BYD's profit before tax did actually not show such a dramatic hit. Now you're looking at profit before tax, and you can see this was only, in quotation marks, down 33% year over year. But as you just saw, this was likely mostly driven by subsidies more than doubling operating income, because it makes a giant difference whether you report a 33% drop in income or a nearly 70% drop. Investors won't be happy about either, but it basically helps to dampen the blow. But what would this look like if we actually stripped out other income? And this is what this chart shows you. So profit before tax would be down to 611 million from over 1 billion. So this is a reported profit before tax. So 1 billion and 70 million. And this is what it would be excluding. The year-on-year change is the same, 33%, because last year BYD got a similar amount of other income, or call it subsidy. So what about profit margin? So the pre-tax margin or profit before tax margin dropped to 3.84%. And this is again a multi-year low, but again, this includes the significant subsidy that made a big difference. So basically, the bottom line is BYD's quarter was quite bad, but these received subsidies made it look significantly less bad. So what about taxes? This is often a topic that's overlooked. Taxes came in significantly lower than in prior quarters at only 156 million. That's a decrease of 48% year over year. But taxes in absolute numbers don't mean that much, so we need to turn it into a tax rate. And this is what this chart shows you. This is the effective tax rate. And we can see that even on this basis, BYD got some benefit. The effective tax rate decreased to 14.6%. And that should say meaningfully helps the year on year, because last year the effective tax rate was 18.8%. So again, the year on year was substantially helped by subsidies, number one. But then there was even on top of that another benefit via a lower effective tax rate. Next, we look at reported profit after tax, dropped to 918 million. And thanks to these compounding effects we just discussed, the year-on-year decline was only 29%. But again, this is thanks to subsidies plus beneficial tax rate. Then we get to shareholders' net income, was down 30% year over year, but would have been down without subsidy support and more average effective tax rate to probably more than 70% down. So just to recap, so what was driving this? Significant weakness in PHEV sales caused a significant loss in gross margin, probably also driven by price wars in other auto segments like battery electric vehicles. That was compounded by a significant increase in operating expenses, which I have not covered in detail in this video to save a bit of time. But that analysis would have shown that BYD lost efficiency and spending is going through the roof. And then lastly, subsidies help to dampen the blow. So next, let's look at what this means in terms of implied valuation metrics. And in this analysis, I'm just using a trailing 12 months PE multiple. This way, we don't need to talk about outlook or forecast and things like that. We can just look at what was reported and compare it with the share price. On that basis, BYD currently trades at 23.8 times, while the median was just over 22 times over the last 12 months. And you can see that BYD was quite volatile. At one point traded up to almost 29 times trailing 12 months earnings, and then quickly dropped down when Trump announced tariffs in April. Then we saw a significant rally in the stock, causing the multiple to increase significantly. On this next slide, I'm overlaying in black the share price. The share price in Chinese yuan is here on the right axis and the multiple on the left axis. And the two overlap quite materially, and this is driven by the trailing 12 months method I'm using here. I apply intra-quarter smoothing. So my trailing 12 months doesn't jump on the announcement of a new quarter, which creates kind of a staircase shape in the underlying earnings curve. I smoothed it out because I believe, and I will not explain this video why I think there's a more advanced way of plotting multiples. And when we look at the share price now, you can see that several times stock got clearly ahead of itself. And I think the key takeaway is And again, the trailing 12 months multiple is not the ideal multiple, but this video is not a valuation a review of BYD. But just high level, it appears like the stock might still be ahead of itself. And down here in the notes, I just put some references. I warned investors in March, stock was probably too expensive because the outlook was, my financial review back then showed that the company showed significant signs of weakness. Stock traded at the time split adjusted at 124 yuan. And then in April, even though this was like the depth of the market, and the market since then rallied quite significantly, I also warned it's still not improving, and stock was at 118 at the time. So that shows anyone who actually took the time to read my materials made better decisions relative to BYD. But let's move on and talk about free cash flow. So free cash flow is defined in this presentation as operating cash flow less capital expenditures. This is arguably one of, or perhaps the most important metric in any company, at least over the long term. And there are some, and I think without hyperbole, quite shocking realizations. So first of all, in the second quarter, BYD lost almost $2.8 billion in cash. So the business consumed $2.8 billion more cash than what it generated. And that comes after almost $4 billion cash consumption in the first quarter. And that brings now the year to date, so in the first half, cash consumption to $6.8 billion. So what was driving that? The answer is capital expenditures. BYD's capital expenditures increased by over 100%, 105% in the second quarter. And in the first half grew year over year 70%. In the second quarter, BYD spent a record of $6 billion on building factories, buying the tooling, equipment, machines, etc. So a truly enormous investment, while business appears to be entering a slower growth phase. Now we look at operating cash flow. Operating cash flow was 3.2 billion positive, but as you just saw, is nowhere near enough to pay for the huge investment. And you have to ask yourself, if you have a business that requires on an ongoing basis significantly more investment than what it ultimately can return, do you actually have a business? Or what do you have, what is it? I don't know the right term, but the term charity comes to mind. And keep in mind, BYD is not a young company. BYD is over 30 years old, has been around for a long time, and is not just ramping up. It's a huge company, but decades into its business has not been cash flow positive. And I can prove it to you in a minute. But when as I claim, BYD is not cash flow positive, how did they finance themselves? How could they grow so large? And now you're looking at the answer, because BYD doesn't have a lot of debt. So what they did was quite clever. They simply didn't pay their suppliers. And over time, BYD amassed a huge amount of payables. So payables are bills you haven't paid. And up until March, that balance grew every quarter and reached an all-time high of $35.1 billion end of March. And then, if you follow me, you probably read my post about it. There were rumors that the Chinese government was cracking down on this practice in China, because this is not only what BYD does, but almost all the other automakers. And they created enormous pressure amongst the automotive supply chain in China. And it reached a breaking point. And I think the net result of that is what you see on this slide. You see for the first time as of June, a sequential decrease in payables. And that is no accident. So payables reduced by 6% sequentially to 32.9 billion. But to really understand what that number means, we need to turn it into a relative metric. And this is what you see on this slide. This slide shows you days payables outstanding, or short DPO. That metric is widely used to analyze balance sheets. It's simply calculated by taking the average balance of payables and divided by the cost of revenue of the considered period times the days in the considered period. And in BYD's case, that calculation results in 132 days for the second quarter. And that means on average, BYD pays approximately after 132 days suppliers. That, of course, in reality means some suppliers get paid a little earlier, but also some get paid even later than that. But still, if you're not sort of an industry person, that number is still kind of pointless if you don't know what's industry practice. And for that reason, we need to look at some industry peers. And that's what you see on this slide. So in this teal color, this is BYD. And then in these gray lines, a bunch of global automotive peers. SAIC is a large Chinese peer, General Motors. Then we have Tesla, Ford, Kia, Nissan, Hyundai, Toyota, Volkswagen Group, BMW, Mercedes-Benz Group, and Honda. And you can see there's nobody except the Chinese peer that is even close to paying as late suppliers as BYD does. Amongst Western automakers, Japanese automakers, Korean automakers, payments typically range from high 30s to 70 days, which means BYD pays almost, or it takes almost twice as long to pay suppliers as the slowest Western automaker. And what this creates, it's basically a huge ongoing interest rate-free credit facility. So if we go back to payables, so this is almost 33 billion as of June is non-interest bearing. That is effectively a free loan. And conceptually, in terms of how meaningful that impact is or how much benefit it creates, think about it in the following way. Apply to this 33 billion, let's say a market interest rate of 5%. That interest expense, after you take off, let's say 20% in form of a tax shield, because that interest expense would lower your taxable income, and let's say effective tax rate on that would be 20%, you end up with a financial benefit after tax of 1.3 billion. And we just looked at the trailing 12 months multiple of around 22 times for BYD. So now you can apply the 22 times to the 1.3 billion in financial benefit BYD receives. That gives you 29 billion in market value. If BYD just keeps that benefit going, but by keeping payables high on its balance sheet, there's a permanent benefit it receives. You can go even a step further and express this resulting implied 29 billion value and express it in terms of current market value. And we know it's 144 billion. So that benefit is worth about 20% of the company right now. Just high level conceptually. Of course, this would be assuming a reduction to zero, but we just saw BYD pays about twice as long as the slowest Western automaker. So if we assume that BYD reduced it to a more normal range, 70 days, that would still take off 10% of the company. Because that cost would be roughly 650 million per year, again, times 22 times multiple, would mean roughly 15 billion loss in market value, and that amounts to roughly 10% right now. So again, huge benefit from this interest-free loan that is not reflected on the balance sheet. I should say not reflected in the debt. So talking about debt, so actual debt that you can see in the balance sheet of BYD is actually not that much. BYD has only $3 billion of interest-bearing debt as of the end of June. It's up a tiny bit, 1% year over year. Why has BYD such a small amount of debt? And to assess that, we always need to turn it into a relative metric. So here we also look at it in terms of a ratio. And here, sorry, it's the wrong slide. So the leverage ratio looking at now is defined as debt divided by capital. And capital is defined as the sum of total equity plus total debt less intangible assets. And you can see the ratio end of June was only 9.6%. That is not very high. And you can see it significantly decreased from around 19%. But this was driven by BYD's all-time highest capital raise that was completed in March, where BYD raised $5.9 billion in equity. Because that raise then increases total equity. There were also positive earnings, also further increasing equity. That increase in equity increases capital in the calculation of the leverage ratio, while as we just looked at, that remained basically constant. The result is that the leverage ratio drops. I expect that on the back of that, BYD will soon re-leverage and will do this via debt issuance. So I expect this ratio to tick up quite soon. But based on historical trends, BYD was never significantly indebted. But as we just looked at, the reason was BYD pushed or extracted funding from suppliers. So next, let's look at cash. BYD currently, as of end of June, has 15.5 billion in cash. So the 5.9 billion equity raise in March offset the cash burn in the first half. And at the time, BYD announced the intention to raise capital. I warned my subscribers there was a huge red flag. And now we know why they raised. BYD had a huge increase in capital expenditures while operating cash flow was weakening. But there is more. So let's look at financing cash flow. So financing cash flow is the net amount of all the capital issuances and repayments that took place during a quarter. If the amount is positive, it means the business issued more new equity or debt than what it repaid in the quarter. And in the first quarter of 2025, you can see there was a huge positive amount, and that was driven by 5.9 billion equity raise. The number you see is only 5.3 billion because there were some capital repayments. But then you can see BYD didn't stop in the first quarter raising net more capital than what it repaid, since the balance was again positive and quite substantially at 1.6 billion. So in other words, BYD has been a net capital raiser since for the last 4 quarters, although the third and fourth quarter of last year it was quite marginal. But the big realization, and the one I pointed to earlier in this presentation, is if you look at the financing cash flow since 2021, and it's 2021 because we want to exclude the 2020 year, which was heavily affected by COVID. But from 2021, and we could also do the same just from 2022, it doesn't matter. The net result, so if you add up all the financing cash flow, is actually positive 6.8 billion. That means over the last couple of years, BYD was net not able to generate more cash than it consumed. So despite its all its size and everything, it's still not nearly generating enough cash. And this becomes especially clear if you consider that BYD currently sits on 33 billion of payables. And even if it wants to get back to roughly where other companies are, around 70 days of DPO, it would have to cut that balance in roughly half. And that would cost roughly 15 billion or 16 billion in cash expenditure. And that would mean if you adjusted for DPO, BYD's financing cash flow would not be the 6.8 billion shown on this slide here in the bottom right. It would be 16.8 plus about 16 billion. In other words, over the last couple of years, BYD is basically over 20 billion behind. And the key takeaway is effectively that this phenomenal growth that BYD has delivered, and there is no debate about the growth rate. This was truly astonishing. No automaker in history has ever grown this quickly, not even Ford. But that's not a good comparison because it's over 100 years ago. But the point is, this phenomenal growth was not based on, I want to use the word fair business practices, because effectively what BYD did was they sold their product at a price that was not cash positive, and basically muscled a lot of people out of market share and made the suppliers pay for it. So the overall key insight is that we have not seen a BYD in a normal state, because at some point this practice has to change. And then we likely see a BYD that is not growing meaningfully anymore. And then we have to wait and see what actually is the underlying profitability of that business. Because right now the business still is driven by this enormous hype around its significant growth, but that growth is unsustainable. So now before I close, let's go quickly back to the headlines we looked at in the beginning of the video. I think these headlines are not really all that helpful because they always focus on just the key results, of course, but I think they never really spend enough time on the sort of big strategic picture. Because if you really boil it down, what BYD does is it's just using a old school dumping strategy. and used enormous leverage via suppliers to gain enormous market share. So that's the end of this video. If you haven't subscribed to my research on X yet, I highly recommend you do. I share similar reports, but more focused on valuation and actionable entry or exit points in a number of stocks. I recently shared a deep dive into Apple, Nvidia, Xpeng, Xiaomi, NIO, Rivian, Tesla, Meta, Microsoft, Amazon, Palantir, and a number of other companies. And there will be soon new reports on a number of other interesting companies coming. Thank you very much for listening. See you next one. Bye.